In this video, we'll be going over IRS Form 6198, At-Risk Limitations. This is a one-page tax form with 4 parts, and before we get into the meat of this form, we'll outline a couple of details of background information that you should know. The purpose of this form is broken down into these 4 parts, so taxpayers can use this form in part 1 to calculate your profit or loss from an at-risk activity, and then in parts 2 or 3, computing the amount at risk for the current tax year. So we'll get into that in just a moment. And then finally in part 4, calculating your deductible loss for the tax year. And as you can see, there are some nuances that we'll walk through in a moment to determine how you calculate your tax liability. But first, we probably should go over a couple of details. First of all, who should file this form? According to the form instructions, individuals, estates, trusts, and closely held C corporations, as described in section 465A, would be the taxpayers filing 6198. However, probably need to go into a little bit more detail to understand what at-risk limitations mean, which means that we should probably talk a little bit about what at-risk activities are and how to define amounts that are not at risk. So you must file 6198 if during the tax year a partnership where you were a partner or an S corporation where you were a stakeholder had any amounts of capital or investment that were not at risk. You must also file this form if you were engaged in an activity included in the IRS description of at-risk activities and you borrowed amounts that the IRS considers to be not at risk. So we'll cover those briefly before we get into the form. Now in the form instructions, the IRS defines at-risk limitations as rules that apply to losses from the following activities that are entered into for the purpose of producing income. 1, holding, producing, or distributing motion picture films or videotapes. 2, farming, as described in Internal Revenue Code 464E. 3, leasing any Section 1245 property, as defined in Section 1245A3. 4, exploring for or exploiting oil and gas resources. 5, exploring for or exploiting geothermal deposits. And 6, any other activity that is not included in items 1 through 5 above. There are a couple of exceptions for taxpayers holding real property that was placed in service before 1987 or holding a partnership interest that was acquired before 1987. So the other thing that we should discuss is what the IRS considers to be amounts not at risk, because the tax treatment on losses that you're going to declare depends on how much of your investment was at risk versus not at risk. So you are not considered at risk for any of the following types of activities. 1, non-recourse loans used to finance the activity, acquire property, or acquire your interest in the activity, unless the non-recourse loan is secured by your own property that is not used in the activity. So basically, if you have a loan that can be forgiven, that you don't have any collateral that can be taken away, then that's considered to be an amount not at risk. 2, cash, property, or borrowed amounts used in the activity that are protected against loss by a guarantee, a stop-loss agreement, or a similar arrangement. This does not include casualty insurance or insurance against tort liability. But if for some reason you had a 10% stake in a company, but you had an agreement that your loss was limited up to a certain point, then that would be considered not, the amount of risk that you're taking off the table in that agreement would be considered the amount that is not at risk. So 3, amounts borrowed for use in the activity from a person who has an interest in the activity other than as a creditor or who is a related person. So there's a little bit of nuance in that, but basically, if you had to borrow from a person that is already a shareholder or a partner, or if they're a related party, then the IRS considers that to be not at risk. And then finally, 4, any cash or property that was contributed to the activity or to your interest that is either financed through non-recourse indebtedness, protected against loss through a guarantee or stop loss or some similar arrangement, or if you borrowed the money or property from a person who has an interest in the activity other than as a creditor or who is a related person. So you don't have to file this form if you're engaged in an activity that was not specified in the at-risk activities section. So category 6, the catch-all of any activity that is not included in 1 through 5. And you only have amounts borrowed before May 4th of 2004 that are described in the amounts at risk. So if you're not sure about whether or not your investment is completely at risk, partially at risk, or not at risk, then you should probably talk to your accountant. But generally speaking, you would be completing this tax form if you have some sort of arrangement that provides protection against a complete loss. And in that case, your tax write-offs can be limited. And using Form 6198 is the way to calculate that limitation. So we'll start in part 1, where we're going to calculate the current year profit or loss from the activity. So in line 1, if you are a taxpayer other than partners or S corporation shareholders, then you would enter your ordinary income or loss from the at-risk activity without regard to any limitations. So simply subtracting your deductions from your total income for the year. You should not include any capital gains or ordinary gains and losses from the sale or disposition of assets. There will be different places later in the form to enter those amounts. For partners and S corporation shareholders, you would simply enter the amount from box 1 of your current K1, Schedule K1. In lines 2B or 2A, 2B, and 2C, this is where you are going to enter your capital gains and losses. So in line 2A, you'll enter your gains or losses from Schedule D. In 2B, you'll enter the gains and losses from the disposition of assets that you reported on Form 4797, and then on C, if there was another form or schedule that you used, then you'll enter that. So be sure not to enter any amounts in line 2C that you previously entered into either line 2A or 2B. So the form instruction states that, as an example, if you filed Form 4684, which is for casualties and thefts, and you carry amounts from that form to Form 4797, which is the sale of business property, then you would have to properly account for the amount on each line. So you would enter the amount attributable to the casualty and thefts on line 2C. You would enter Form 4684 on the dotted line next to 2C, and then you would if you did that, you would have to make sure that that amount is not included on your Form 4797. So you would have to back that out. So for taxpayers other than partners or shareholders, you would include your current year Schedule D, Form 4797, and then other forms and schedules. Any prior year losses that you could not previously deduct because of the at-risk rules. For partners and S corporation shareholders, you would include your current year gains and losses and then prior year losses attributable to the activity. So the same points, just different forms and schedules for depending on the type of taxpayer. In line 3, you would include any other income and if you're a partner or a share holder in an S corporation, you would include any of those amounts from either your Schedule K1 from Form 1065 or 1120S that was not already previously included. For line 4, you would enter, regardless of taxpayer status, any other losses or deductions from the activity, specifically including any investment interest expense that was allowed from IRS Form 4952, which is the worksheet calculating the investment interest expense deduction. So you would include that here. If you filed Form 6198 for a prior tax year, then you would also include on line 4 any investment interest expense that was limited in the previous year because of the at-risk limitation rules that applied then. And then line 5, you'll combine lines 1 through 4. You'll notice that line 4 was a deduction. You'll enter that, and that's parentheses, but you're going to add lines 1, 2, and 3, and then subtract line 4. If line 5 shows a current year profit, you might not have to complete the rest of the form. You would report all the income, deductions, gains, and losses shown as normally attached or normally used, and then attach them to your tax return. You would also attach, you would keep a copy for your records. If it shows a current year loss, then your loss might be limited to the income or gains if you had any that were included on lines 1, 2, and 3. You would separate these lines of income, gains, deductions, and losses on lines 1 through 4. The income and gains are fully reportable on your tax return. The deductions and losses are allowable to the extent of the income and the gains. So we'll walk through the rest of the form to see how much, if any, of the excess loss can be deducted. So in Part 2, Part 3, you usually would do one or the other. You don't need to do both. You can calculate Part 3 without going through Part 2, and you can use Part 2 as a simplified method for determining your amount at risk, but only if you know your adjusted basis in the activity or in your interest in the partnership. So Part 3 takes a little bit longer, but it also might allow a little bit larger amount at risk. We'll go through each of these step by step, but you don't need one to do the other, and there might be situations where you can only do Part 3. So we'll cover Part 2 first. So in line 6, Depending on your taxpayer status, you're going to have to determine your adjusted basis in the activity on the first day of the tax year. If you have negative basis, do not enter a number less than 0. But specifically for sole proprietors, if you're filing Schedule C or F, then you cannot reduce the amount on this line by any liabilities, and you should probably refer to publication 551, basis of assets, for rules on adjustments to your basis. For partners, to determine your adjusted basis, publication 541, partnerships, would be the appropriate publication. And for S corporation shareholders, you should find the information in the instructions for Form 1120S. In line 7, you're going to enter any increases for the tax year. So don't include your current year income or gains, but you will include the following. These are 4 things that would increase your basis for the year. So 1, the net fair market value of the property that you own, which secures non-recourse loans used to finance the activity, to acquire the activity, or to acquire property used in the activity. Generally, the net fair market value is determined when the property is pledged as security for the loan. So if you need more information, the form instructions do a little bit more explanation in breaking this down for you. 2, cash and the adjusted basis of other property that was contributed to your activity during the tax year. So if there's an increase in cash, or if the adjusted basis of any property that you contributed, if that goes up during the tax year, then it would make sense that your basis for this goes up as well. 3, any loans that were used to finance the activity, acquire property used in the activity, or to acquire your interest for which you are personally liable, and qualified non-recourse financing. So if you have any questions about qualified non-recourse financing, the form instructions do go into a little bit more detail, but quickly. Qualified non-recourse financing is financing for which no one is responsible personally for repayment, and either you borrowed it in connection with holding real property, the real property was the loan was secured by real property used in the activity. It's not convertible debt, and it is loaned or guaranteed by a federal, state, local government, or borrowed from a qualified person. So a qualified person is someone who is not related to you. It's not the seller of the property, and it's not someone that receives a fee from you. And again, more details with the nuances in the form instructions. And then finally, the 4th item that would increase your basis would be any percentage depletion for this year that was deducted in excess of the adjusted basis of depletable property. So in line 8, you'll combine lines 6 and 7, and then for line 9, you'll figure any decreases. So don't include anything from part 1, but the following items, according to the form instructions, do decrease your amount at risk. So any non-recourse loans other than qualified non-recourse financing. So only amounts that were entered here in line 6 can be entered here in line 9. Any cash, property, or borrowed amounts protected against loss by a guarantee, stop loss, or a similar arrangement. Enter that amount only if it was previously entered on line 6. And then number 3, amounts borrowed from a person who has an interest in the activity other than as a creditor or a related person. And then 4, withdrawals and distributions during the tax year, both cash and the adjusted basis of non-cash items. And then 5, non-recourse liabilities that were included on line 6 of property that you contributed to the activity. So those are all things that decrease your amount at risk for the tax year. And then in line 10A, you'll subtract line 9 from line 8. So far we've taken the beginning of the year at-risk amount, any increases we've added, any decreases we subtracted, and the result now goes on line 10A. For 10B, if this number is more than 0, then you would enter that amount in 10B, and then you go directly to line 20. Otherwise, you enter 0, and then you would have to go to IRS publication 925 for more information on the recapture rules. If the amount on this line is smaller than your overall loss for the year on line 5, meaning that you can't deduct the full amount, then you may want to go ahead and do the calculations in part 3 just to see if you're able to increase the amount that you say you have at risk. So again, the more that you have at risk, the more of a loss that you can deduct on your tax return. And then the less that you have at risk, the lower deduction. So if you completed so we're on to part 3 right here. And the first thing it says is if you completed part 3 for the prior year, see the instructions. So the instructions state, if you completed this for the prior tax year, then skip lines 11 through 14. So you'll have to refer to the instructions for lines 15 and 16 and the instructions for line 18 to determine what to enter on those amounts. If the activity began on or after one of the effective dates shown below in the instructions, and you did not complete part 3 for the prior tax year, then you'll skip lines 11 through 14. You'll enter 0 on line 15, and then you'll complete the rest of this. So, effective date is the first day of the tax year beginning after 1975 if the activity is described in one of the at-risk categories 1 through 4 that I previously discussed in the form instructions. So holding, producing, or distributing motion picture films, farming, leasing Section 1245 property, or exploring for or exploiting oil and gas resources. Number 5, geothermal deposits. The instructions specifically set that aside because if that activity, the effective date is usually October 1st, 1978 for wells that were started after September 30th, 1978. So what this means is a well that was started before October 1st, 1978 is not subject to at-risk rules. And then wells started after September 30th can be subject to the at-risk rules. So, starting in line 11, your investment in the activity or your interest in the activity at the effective date. And again, there is a worksheet in the form instructions for taxpayers who are not partners or S corporation shareholders. And basically, this walks you through, how much your investment in the activity was at the first day of the tax year after 1975. So once you complete the line 11 worksheet, you'll enter that amount into line 11. For line 12, there's also a worksheet, and you're going to use this to determine your total losses from years before the effective date for which there were equal or greater amounts not at risk at year end. So in line 12, you're going to enter your share of amounts such as the following examples. 1, net fair market value of your own property that secures a non-recourse loan but is not used in the activity. But the loan is used to finance the activity, acquire property, or acquire your interest in it. And the net fair market value is determined when you pledge that property as security for a loan. And then 2, total losses from years before the effective date for which there were equal or greater amounts not at risk. And this is where you would use the line 12 worksheet and its instructions to figure that amount. So if you're using part 3, you're going to be leaning a little bit more on the form instructions because you need to kind of use this to figure out your at-risk amount. So in line 13, you're going to combine those two lines, the investment in the activity plus any increases. And then on line 14, you'll enter any of the following decreases that may apply to your situation. So 1, non-recourse loans outstanding at the effective date used to finance the activity or finance property or to acquire your interest in the activity. 2, cash, property, or borrowed amounts that were protected against loss by a guarantee or stop loss or a similar arrangement. 3, amounts outstanding at the effective date that were borrowed from a person with an interest in the activity other than as a creditor or who is related. And then 4, if you're not an S corporation shareholder, you need to also include liens and encumbrances on any property that you contributed on line 11. If you are an S corporation shareholder, do not include any loans that were assumed by the corporation or liens or encumbrances on property that you contributed. So in line 15, you're going to check the box that applies, either the amount that's at risk, or if you completed part 3 in a prior year, you're going to take the number from line 19B. So you don't need to include this amount, the line 10B from your prior form. You'll simply go to your prior year form and enter the amount that's here. And then you do not need to go through the investment in activity and increases and decreases. You've already done that. So the line 16 are increases since either the effective date or the end of your prior year. So in line 16, if you completed this form in the past in a prior year, you'll check box B, and then you'll enter any of the following increases. There are 9 of them. So 1, net fair market property, a value of property that you own, not used but securing non-recourse loans used in financing the activity, acquiring your property used, or acquiring your interest. 2, cash and the adjusted basis of other property contributed since the effective date or since the prior year. 3, loans for which you are personally liable that were used to finance the activity, acquire property, or to acquire your interest in qualified non-recourse financing. But don't use any amounts that were listed previously. So 4, total net income since the effective date. Don't enter amounts less than 0, and don't include current year income or gains. 5, gain recognized on the transfer or disposition of all or part of the activity or your interest in the activity. 6, amounts that you included in income since the effective date because your amount at risk was less than 0. 7, all money from outside the activity used since the effective date to repay any loans. 8, a percentage depletion deducted in excess of the adjusted basis. And then finally 9, if you're an S corporation shareholder, then you enter the loans that you've made since the effective date. So in line 17, you'll add all of these lines, and then on line 18, you'll enter decreases, which generally are the opposites of everything I just said. So you'll enter in decreases any cash, property, or borrowed amounts that were protected against the loss by a guarantee, stop loss, or similar arrangement. 2, amounts borrowed since the effective date from a person with an interest in the activity other than as a creditor or who is related. 3, cash in the adjusted basis of other property withdrawn or distributed since the effective date. 4, recourse loans that were changed to non-recourse loans since the effective date. So if you borrowed money and then the lender allowed you to change this to a non-recourse loan, this would decrease the amount that you have at risk. So you would mark that as a decrease. 5, any losses in this activity since the effective date. 6, non-recourse liabilities that you contributed since the effective date. 7, any other at-risk amounts that change to amounts not at risk. And then 8, if you're an S corporation shareholder, do not include any loans that were assumed by the corporation or liens or encumbrances on property that you contributed. So again, you're going to check the appropriate block, then you're going to subtract line 18 from line 17. That gives you the result in 19A. If this amount is more than 0, then you'll enter that amount in 19B and then go on to line 20. If it's 0 or less, then you'll enter 0 and then go to IRS publication 925 for more information on recapture rules. So at the bottom, part 4, simply enter the larger of either 10B or 19B. Again, 10B would be what you calculated with the simplified computation. If part 3 gives you a little bit more at risk, then you can use that number. And the larger the number at risk, the more of a deductible loss that you will have. And so, as you can see, right under line 20, you're going to enter the smaller of the loss that was listed here, the actual current year loss, or the amount that you had on line 20, which is the amount at risk. And then in the form instructions, they detail how to report deductible losses and then carryovers, and this is what they say. If the loss on line 5 here is equal to or less than the amount on line 20, then you'll report the items in part 1 in full on your tax return, subject to other limitations such as passive activity or capital loss limitations. If this amount is bigger than line 20, then that means your at-risk rules come into play. And you must limit your deductible loss to the amount that's on line 20, subject to those other limitations. The specific example from the form instructions state if line 5 is a loss of $400 and line 20 is $1,000, then you enter negative $400 on this line. If line 5 is a loss of $1,600 and the line 20 is $1,200, then you would enter $1,200 here. And if this line here happens to be 0, then you would enter 0 no matter what line 5 says. So if the amount on line 21 is made up of only one deduction or loss item, then you report this on your return, the amount that's shown in line 21, subject to other limitations. If it's made up of more than one deduction or loss item in part one, like if you have a Schedule C loss and then you have a Schedule D loss, then you have to determine an appropriate portion of each type of loss. For example, a Schedule D loss might have different tax treatment than a Schedule C loss. So you would have to take that into account, and you would have to basically take a prorated amount of each loss depending on how what the loss on line 21 is. You would take a fraction, the appropriate fraction from each category. The remaining portion of each deduction or loss item from the activity is disallowed and has to be carried over to the following tax year. So additional rules do apply if you have losses from a passive activity loss. Then you would have to go to Form 8582, corporate passive activity loss and credit limitations. Then you would go to Form 8810, the instructions on there. So I think that is it for this form. And again, we've written a comprehensive how-to article on our website, which you can reach. Simply go to teachmepersonalfinance.com, type in IRS Form 6198 in the search bar, and you should see our article. If you like our articles, please subscribe to our newsletter. If you like our videos, please subscribe to our YouTube channel. And as always, if you have any questions or comments or concerns, feel free to either drop a comment in the comment section or send me an email. Thank you very much.